Big Tech's 2026 spending plans point to a roughly $800 billion wave around AI infrastructure. The suppliers selling the chips, cables, buildings, and electricity can get paid now, while the companies buying the infrastructure may need years to prove that it earns an acceptable return. That gap is the entire mystery. A purchase order confirms demand. It does not certify a good investment. So instead of declaring an AI boom or an AI bust from the doorway, we are going to follow the invoice. Then we will test the buyers with a 5-part earnings scorecard: revenue growth, utilization, margins and depreciation, free cash flow, and financing quality. By the end, the question will be narrower and more useful, not whether AI is real, but whether the owners of all this machinery can turn very visible spending into returns worth waiting for. First, the label on the invoice needs honesty. The Associated Press reported that Alphabet, Amazon, Meta, and Microsoft plan to spend up to $720 billion in calendar 2026, primarily on AI data centers. Oracle's fiscal 2026 results show $32 billion of operating cash flow and negative $23.7 billion in free cash flow. Because free cash flow subtracts capital spending from operating cash flow, the gap implies roughly $55.7 billion of capital spending. Together, the broader basket reaches about $775.7 billion, approaching $800 billion. That is a rounded hyperscaler capital spending envelope, not an exact measure of AI-only spending. It mixes calendar year plans with Oracle fiscal year actuals, and no company reported the combined number. Definitions vary and can include cash purchases, leases, and other commitments. Accounting departments still enjoy having hobbies. The money does not all buy the same thing. The envelope also includes non-AI cloud capacity, buildings, networking, leases, and company-specific programs. A data center may serve ordinary cloud workloads beside generative AI. A building can remain useful longer than the servers inside it, and an Amazon investment line can include projects beyond cloud. $800 billion is therefore fair shorthand, with the label attached, roughly broadly AI-driven and not an audited AI-only total. Now follow one hypothetical spending dollar as it leaves an infrastructure owner. The first stop is accelerators, the specialized chips doing much of the heavy computation. The chip vendor can recognize a sale when the equipment is delivered under its contract. Demand has become revenue for the supplier. But for the buyer, the same chip has only started its audition. It still needs workloads, customers, uptime, and pricing strong enough to recover its cost. Next comes memory. Accelerators need fast memory to keep data moving instead of leaving expensive processors waiting. Memory manufacturers collect their share as servers are assembled. That is another real payoff from the build-out, and another purchase that says nothing yet about the profit eventually produced by the completed system. Then the dollar reaches networking. Switches, optical links, cables, and related equipment connect thousands of machines so they can operate as one system. Network suppliers get orders, installers get contracts. The infrastructure owner gets a larger asset base and a new requirement: keep the entire cluster busy enough that all those connections carry valuable work. The equipment still needs a home. Developers, construction firms, electricians, and equipment makers are paid to secure sites, raise buildings, install substations, and fit out data halls. Those contracts can support revenue long before the first customer query runs through the facility. A finished building proves that concrete cures. It does not prove that capital allocation does. Then comes power and cooling. Utilities sell electricity, grid and generation partners sign contracts, cooling vendors provide the equipment that removes heat from dense racks. These are genuine businesses with genuine cash flows linked to the spending wave. They can win even if the data center owner's eventual margin is mediocre. Before the dollar reaches these suppliers, ask where it came from. Some comes from operating cash flow, some from customers that prepay or supply equipment, and some from debt. Banks and bond investors are not another destination for the spending dollar. They supply capital. Immediate outbound finance costs can include underwriting or arrangement fees. Interest arrives later, creating another claim on future cash. This is why the invoice matters. At every stop, someone can point to an order, a contract, a shipment, or a payment. The money trail demonstrates that purchasing demand is visible and equipment demand is real. What it cannot yet demonstrate is the infrastructure owner's return after utilization, operating costs, depreciation, financing, and competition. The suppliers can know they made a sale. The owner still has to prove it made an investment. The immediate payoff is the supplier receipt, and NVIDIA provides the clearest one. In fiscal 2026, NVIDIA's data center revenue reached $193.7 billion, up 68%. That is not a survey or forecast. It is revenue from a completed fiscal year, making the supplier payoff concrete. Customers bought data center products at extraordinary scale. At this size, the invoice needs its own postal code. That result answers one narrow question: is purchasing demand real? Yes, it does not answer whether the buyer will earn an acceptable return. The supplier's commercial job can be complete when delivery terms are met. The buyer's economic job begins there. The hardware must attract paying workloads whose revenue covers operating costs and invested capital. One transaction starts two clocks. Imagine two infrastructure owners buying identical accelerators at the same price. NVIDIA records the same sale either way. One owner keeps the machines busy on durable, well-priced workloads and earns enough to cover electricity, cooling, networking, and maintenance. The other runs at lower utilization, cuts prices to attract demand, or faces higher operating costs. Its hardware can perform exactly as promised while producing less revenue per dollar of installed capacity and a thinner margin on each hour used. The same hardware sale produces two different owner economics. Utilization spreads the asset cost across more productive work. Pricing determines the revenue earned from that work. Operating costs determine how much revenue survives before depreciation and financing. A full server room can still disappoint if falling prices consume the benefit of higher volume. An expensive cluster can work if utilization, pricing, and efficiency remain strong. The equipment receipt proves a purchasing decision. It does not settle the economics. NVIDIA can therefore convert the build-out into revenue before infrastructure owners prove an adequate return. The supplier payoff is real, but the buyer verdict remains open. To test it, we have to switch from the seller's invoice to the buyer's accounts. Cash can leave when the equipment arrives, yet only part of the cost may appear in earnings at first. Why does the economic bill seem to arrive later? Capitalization explains the delay. When a company buys a server expected to produce revenue for several years, it generally does not put the entire price on that day's income statement. The cash still leaves. The cash flow statement records capital expenditure, while the balance sheet records an asset. Accounting spreads the cost across the periods expected to benefit. That recurring expense is depreciation. In a simplified example, a $600 million server purchase depreciated evenly over 6 years produces roughly $100 million of expense each year, although the cash left much earlier. Timing can differ as equipment enters service, but the separation remains: cash now, expense over time. Current earnings can look stronger than if the full purchase hit profit immediately. The cost has not disappeared. It has joined a schedule. Oracle shows that schedule getting heavier. The company reports an estimated useful life of 6 years for servers and networking equipment. Separately, Oracle's total depreciation expense on property, plant, and equipment rose from $3.9 billion in fiscal 2025 to $7.6 billion in fiscal 2026. The filing does not disclose a server-only total, so the entire increase cannot be labeled AI server depreciation. What it does show is more of Oracle's property and equipment investment moving through the income statement. Now picture the depreciation conveyor. Each spending year creates a layer of future expense. The next year adds another before the first is finished. As assets enter service, several purchase years can contribute depreciation at once. Even if spending stops growing, recent layers may keep arriving while older ones run off. Accelerating spending builds the stack faster. Every new spending year sends a nervous risk intern back with another page for the depreciation folder. The folder is now the department's fastest growing asset. 6 years is an accounting estimate, not a warranty on competitive economics. A server may remain functional but become less attractive if newer hardware does more work with less power, prices fall, or demand fails to keep it busy. Useful life describes how management allocates cost under its accounting policy. It does not prove the asset remains equally productive, profitable, or competitive for all 6 years. That distinction is crucial for investors. Depreciation is a real expense tied to prior investment, but it arrives after the cash decision and in measured installments. During a fast build-out, operating profit can show only part of the burden while the cash flow statement is already absorbing today's much larger purchases. Then new depreciation layers keep entering earnings even as management decides whether to spend again. This is how a company can report healthy current earnings and still face a tightening investment problem. If cash spending accelerates before the income statement catches up, free cash flow feels the pressure first. The delayed bill is no longer hidden once we compare reported profit with the cash still leaving the business. That is where the money trail goes next. Free cash flow is where the delayed bill stops being theoretical. It asks a blunt question. After the business pays for today's operations and today's investment, how much cash remains for owners, debt reduction, or the next project? 3 companies now offer 3 different warning signals. They are signals to investigate, not 3 copies of the same verdict. Amazon shows cash reinvestment. In its first quarter 2026 results, trailing 12-month free cash flow fell to $1.2 billion. The company said the decline was driven primarily by a $59.3 billion year-over-year increase in property and equipment purchases, net of proceeds from sales and incentives, which primarily reflected artificial intelligence investment. That is cash sacrificed today, but not proof it was wasted. Amazon also reported strong AWS growth, giving the risk a meaningful counterweight. The warning is timing. Cash is leaving faster than the new asset base has proved its full owner return. Oracle shows external financing. Fiscal 2026 free cash flow was negative $23.7 billion, and the company raised $43 billion of debt financing. Oracle generated substantial operating cash flow and has customer commitments we will examine in a moment. Debt service rests on Oracle's total company cash generation, not cloud cash flow alone, and principal can be refinanced rather than repaid on its original schedule. Even so, incremental cloud economics must justify the added capital and financing cost. Rising depreciation is the accounting echo of prior investment and raises that hurdle. The financing signal makes execution less forgiving without making failure inevitable. Microsoft shows margin pressure. In its fiscal 2026 third quarter, Microsoft reported that continued AI investment weighed on cloud gross margin even as cloud revenue grew. That is precisely why revenue growth alone is an incomplete scorecard. More sales can coexist with a less profitable mix when depreciation, power, chips, and other infrastructure costs expand. The counter-evidence is inside the same fact. Revenue was still growing, which suggests customers were buying more cloud services. The warning is that the cost of serving that growth can absorb part of the benefit. If efficiency gains, utilization, or pricing improve, the pressure can ease. If they do not, volume can rise while owner economics lag. Put the 3 signals side by side. Amazon is choosing to recycle operating cash into assets. Oracle is supplementing internal cash with outside capital. Microsoft is showing pressure within the unit economics of cloud. Cash reinvestment, financing exposure, and margin pressure sit on different statements and can resolve differently. The dashboard has warning lights, not a self-destruct button. None of this proves the AI investment cycle is failing, and none supports a guaranteed bubble verdict. It says the income statement cannot be read alone. We need to ask whether spending produces enough profitable demand, whether funding remains durable, and whether revenue grows faster than the combined drag from operations, depreciation, and financing. That brings us to the fairest counterargument. If the warning signs are real, what is the strongest evidence that the buyers can still earn their way through them? The bull case begins with paying cloud customers. In the first quarter of 2026, Amazon reported AWS sales of $37.6 billion and operating income of $14.2 billion. This is a large, profitable operating business during the build-out. AWS is a major potential monetization channel, but Amazon does not map company-wide capital spending exactly to AWS or AWS profit exactly to AI, so the linkage is directional. Oracle adds contracted demand and shared funding. Its remaining performance obligations reached $638 billion, while customer prepaid or customer-supplied AI hardware totaled $75 billion. Those arrangements can reduce how much capital Oracle must provide itself and show customers committing resources, not merely clicking through a product demo. But backlog is neither recognized revenue nor profit. Oracle still has to deliver the service, collect according to the contract, control operating costs, and earn an adequate margin after depreciation and financing. NVIDIA's data center revenue is also real, and it was recorded at enormous scale. Meanwhile, the hyperscalers retain powerful cash-generating businesses in cloud software, advertising, commerce, and platforms. Those engines can finance experimentation, absorb uneven ramp periods, and give management time to improve utilization. This is the strongest case, not a complete verdict. Existing profits can fund weak projects as easily as strong ones, and supplier sales reveal purchases rather than buyer returns. Customer prepayments improve financing quality, but do not erase delivery obligations. Large cloud businesses prove a monetization channel exists. They do not prove every new data center dollar earns the old software margins. The bull case earns respect because it shows capacity to fund the build-out and evidence of customers, revenue, contracts, and operating income. It still has to pass the owner return test. The useful divide is not real demand versus fake demand. Demand is plainly real in several places. The hard question is what remains for owners after utilization, pricing, operating costs, depreciation, and financing interact. High utilization and durable pricing can spread the asset cost over more valuable work. Low utilization, price competition, expensive power, or rapid obsolescence can reverse that math even while headline revenue rises. So the next step is to turn these competing signals into a disciplined threshold. What return hurdle must the investment clear? Think like an investment committee for a moment. Not the kind that approves a project because the presentation contains the word strategic 18 times. A real committee asks what the asset must earn after every layer of cost, and what would make the answer change. The first layer is capital recovery. The company is paid for chips, servers, networking, buildings, and power equipment. Depreciation spreads part of that cost through reported earnings, but the economic question is tougher. Will the asset generate enough cash before it becomes obsolete, underused, or less competitive? Recovering the accounting expense is necessary. Recovering the actual capital while earning a return is the goal. The second layer is operation. Data centers consume electricity, cooling, maintenance, software, networking, land, and labor. Those costs continue whether the cluster is extremely busy or merely producing an expensive impression of a space heater. Utilization matters because a largely fixed asset base becomes easier to support when more valuable work moves through it. But utilization alone is not enough. A fully occupied cluster earning falling prices can still produce disappointing margins. The third layer is financing and opportunity cost. Debt has interest and fees. Internally generated cash has no invoice attached, but it is not free. Management could have used it for another project, reduced debt, repurchased shares, or simply preserved flexibility. Equity financing also has a cost because existing owners surrender part of future upside. Different funding mixes change the risk, but none makes capital disappear. The fourth layer is the profit required to justify uncertainty. Investors do not fund a volatile, fast-changing infrastructure cycle merely to recover every dollar and receive a polite thank you note. The project must earn more than its operating and capital costs, with enough cushion for weaker pricing, slower demand, outages, construction delays, and newer hardware arriving before the old hardware has finished paying for itself. There is no honest, universal break-even number available from public disclosures. The companies do not isolate AI-only capital spending, AI-only operating cost, internal productivity gains, advertising improvements, conventional cloud workloads, and customer-specific pricing in one neat table. Any precise industry-wide utilization threshold would therefore be an assumption wearing a name badge. But the sensitivity is clear. Higher utilization spreads fixed costs across more work. Stronger pricing raises revenue per unit of work. Better energy efficiency protects margin. Longer economically useful asset lives improve capital recovery. Lower financing costs reduce the hurdle. Move those variables the other way, and the same data center can shift from attractive to mediocre without ever becoming empty. That is why the largest spending total does not identify the eventual winner. Execution decides whether the invoice becomes productive capital or a very sophisticated collection of future expenses. So during earnings season, use 5 checks. First, follow AI-linked cloud and platform revenue. Look for growth that is large enough to matter relative to the expanding capital base, not merely a fast percentage attached to a tiny starting point. Separate reported revenue from management estimates, backlog, and broad claims about opportunity. The question is whether monetization is catching up with investment. Second, listen for utilization and capacity commentary. Is new capacity filling with durable customer work? Are shortages easing because supply arrived or because demand softened? Management rarely publishes one clean utilization number, so consistency across pricing, capacity additions, contract activity, and efficiency commentary matters. Third, compare cloud gross margins with depreciation growth. Revenue can rise while the cost of delivering it rises faster. Improving margins alongside heavy investment suggests that utilization, pricing, or efficiency is getting better. Falling margins are not automatic failure, but they increase the revenue required for an adequate return. Depreciation tells you how prior purchase orders are reaching current earnings. Fourth, watch free cash flow after property investment, leases, prepayments, and other infrastructure commitments. A company can report excellent operating profit while cash disappears into the next construction cycle. The useful comparison is not one weak quarter. It is whether free cash flow improves as capacity begins producing revenue or remains structurally compressed while spending and obligations keep rising. Fifth, inspect financing quality. Is the build-out funded mainly from durable internal cash generation, customer prepayments, debt, equity, or long-term commitments that still require future funding? Debt is not automatically dangerous, and internal cash is not automatically wise. The better structure is the one that leaves enough flexibility if demand arrives later, pricing falls faster, or technology changes sooner than expected. Those 5 checks turn the headline into a testable claim. Revenue shows monetization, utilization shows whether the assets are working, margins and depreciation show what survives accounting costs. Free cash flow shows the immediate burden. Financing shows who carries the risk and how long the company can wait for the payoff. So, will roughly $800 billion of AI-driven infrastructure spending ever pay off? For suppliers, part of it already has. For customers, commercial demand is real. For the companies owning the infrastructure, the final return remains unproven. The bet works when utilization, monetization, and durable margins grow faster than depreciation, operating costs, and the cost of capital. It disappoints when impressive revenue sits on an even more impressive asset base and produces too little cash for the risk taken. Both outcomes can exist at the same time across different companies. AI can transform the economy while still producing uneven investment returns. The best technology does not automatically create the best owner economics, and the company spending the most is not automatically the company earning the most. This is not a buy-or-sell verdict. It is a framework for reading the next earnings call without confusing a supplier receipt, a backlog number, or a spending announcement with a completed return. When the next CapEx forecast rises, run the 5 checks. The invoice will be obvious. The payoff will have to prove itself.